Legendary investor Michael Burry is investing very heavily into Chinese stocks. In this video, we'll analyze his top 3 Chinese stocks that you must know about following the rise in the Chinese stock market. First, we'll look into key financial metrics and news for the 3 stocks. And in the second part, we'll find out what drove the stock market rally while looking at the major pros and cons of investing in Chinese stocks. China's very impressive stock market rally in 2024 saw the CSI 300 index rise over 20% in September. Meanwhile, the Shanghai Composite Index rose an impressive 15.8% from the beginning of September to the end of October. Michael Burry's fund Scion Asset Management now has around half its portfolio invested in the 3 Chinese stocks we're going to analyze in this video. The first stock we'll look at, which Michael Burry bought a significant stake in, is tech giant Alibaba. Alibaba is currently the largest position in his fund's portfolio. According to his company's 13F filing for the third quarter of 2024, Scion Asset Management has a little over 20% of its portfolio in Alibaba. However, we must be aware that Burry also holds $18 million of bearish put options on Alibaba to help hedge his risk in case the stock drops significantly. So what does the tech giant Alibaba actually do? Well, the answer is many things, ranging from online retail marketplaces to wholesale trade. Alibaba is a multinational technology conglomerate that runs through its major segments, which are core commerce, digital media, and cloud computing. The cloud computing segment has Alibaba Cloud, which provides a database facility, storage network, big data analytics, and other services. Also, their other innovative divisions shouldn't be overlooked, as they include DingTalk, AutoNavi, Tmall, Genie, and others. The famous leader behind Alibaba that we all see in the media is Jack Ma, who co-founded the company in 1999. The other leading co-founder was Cheng Tsai. However, many people don't realize the company was actually founded with 17 original members in Hangzhou, China, where it is still currently headquartered. The market cap of Alibaba is $216 billion, which makes it comfortably in the top 5 largest Chinese companies. The view toward investing in Chinese stocks became negative following the regulatory clampdowns in recent years, most notably after Alibaba's case in 2021. The State Administration for Market Regulation announced a $2.8 billion fine for Alibaba for behaving like a monopoly. However, the Chinese government wants money to flow into their businesses by trying to boost shareholder returns. It's evident by the scale of stimulus measures that this is the case, particularly as we see an extremely low interest rate of only 2.25% for companies to take out loans for stock buybacks. The narrative from many Western media companies claiming the Chinese government is not trying to increase shareholder returns is untrue. Luckily for Alibaba, the fine only amounted to 4% of their sales in 2019, so the company recovered quickly. Despite concerns about potential regulatory crackdowns, Alibaba has seen a sharp rise of over 30% since the beginning of 2024, while maintaining a P/E ratio of under 30. Additionally, in September 2024, Alibaba announced it would collaborate with NVIDIA on artificial intelligence that will enable Chinese automakers to develop autonomous driving. Next, we'll take a deeper look into Alibaba's key financial metrics so you can better understand its value. The trailing 12-month dividend yield is 1.08% and was last issued in July 2024. You can see other vital statistics here, such as the total revenue, which was $131 billion in 2023, which is up 3.5% from 2022. Gross profit was up slightly more at 3.9% as it hit $46.4 billion, while operating income rose to $17.2 billion. As a result, pre-tax income was $14.1 billion, while net income was $11.1 billion, which is 5.1% higher than in 2022. Alibaba's financials are attractive to long-term investors due to its substantial cash reserves. In April of 2024, Alibaba held around $81.6 billion in cash, which is nearly 50% of its market cap of $167 billion. This strong cash position is reflected in its low enterprise value to free cash flow ratio, reaching 4.19 at one point, yielding a free cash flow rate of 25%. The second major stock Michael Burry's Scion Asset Management bought in the third quarter of 2024 is Baidu. The stock now makes up 10.14% of his portfolio. However, he also purchased put options worth 6.76% to help hedge his risk. Baidu is an internet search provider which operates from its platform Baidu.com. The website allows users to search for web pages, images, news, documents, and other media files. The business has three main sections: search services, transaction services, and IQI. The search services offer pay-for-performance marketing capabilities based on users' search queries. The transportation services include Baidu Takeout, Baidu Nuomi, Baidu Maps, Baidu Connect, Baidu Wallet, and more. Lastly, IQI is a video platform allowing users to watch a wide variety of movies and TV shows. The current market cap of Baidu is $29 billion, which makes it almost 10 times smaller than Alibaba. Also, the company does not currently pay dividends. However, there are many strong factors for investing in Baidu. Now that we understand what Baidu does, let's take a deep dive into the company's financials. Revenue was up by 3.4% to $19 billion, while gross profit grew by a massive 10.68% to $9.8 billion. Even more impressive was the operating income growth at 30.5%, coming in at $3.08 billion, up from $2.3 billion last year. However, the most impressive results were from the pre-tax income and net income, which both grew over 100%. Pre-tax income was $3.56 billion, which was up 136%, and net income was up to $2.77 billion, an incredible 167% higher. Michael Burry clearly sees high potential growth with Baidu following these financial results. Additionally, the stock is at a current price-to-earnings ratio of only 11.1, which is down from last year's 15.3. A low PE ratio is attractive, especially considering the current PE ratio of the S&P 500 is around 3 times higher. The price-to-cash flow ratio also looks good at 10.1. The third and final stock that Burry invested heavily in is JD.com, which now accounts for 15.4% of his portfolio. The position ranks second in his portfolio and less than 1% smaller than his largest position in Alibaba. However, it's essential to be aware that he also holds the same position in put options to balance his risk if the stock drops. JD.com is a tech e-commerce business that primarily deals with selling electronic products and general merchandise. The company was founded in 1998 and now sells products including videos, audio, and books. It operates mainly in JD Retail and JD Logistics. The retail side primarily operates through online retail and marketing services. Meanwhile, JD Logistics handles both internal and external logistics. The market cap is $51 billion, putting it in between Baidu and Alibaba. Meanwhile, the dividend yield has been quite impressive at 2.09% for the last 12 months. Now, let's look further into the financials, starting with revenue, which is down 1.47% to $153 billion. Gross profit was up 3.28% to $22.3 billion, while operating income was up a massive 49.78% at $4.08 billion. Similarly to Baidu, the pre-tax income and net income saw even larger annual increases. Pre-tax income was $4.47 billion, coming in at 116.92%, and the net income was $3.41 billion, which is plus 121.28%. That's not bad, to say the least. Additionally, with a price-to-earnings ratio of only 11.26, it's easy to see why Burry views this stock highly. The price-to-cash flow ratio was also strong at only 7.3. Part 2. We'll look at what drove the Chinese stock market rally in late 2024 and the major pros and cons of investing in Chinese stocks. The incredible speed of the rally caught the world by surprise and renewed interest in the Chinese stock market. Despite popular indices such as the CSI 300 and Shanghai Composite pulling back slightly in October 2024, the Chinese stock market remains high on the list for many investors. We must bear China's real estate crisis in mind because it helped lead the government towards aggressive policy changes to stimulate the stock market. Key changes include lowering short-term interest rates on mortgages, which should help ease real estate market concerns. The Chinese said the mortgage rate cut will help Chinese households save over $21 billion per year. Another major policy comes from the People's Bank of China announcing a 50 basis point cut in the reserve ratio. The reserve ratio determines how much cash a bank needs to keep free. The government reduced the reserve ratio from 10 to 9.5%, allowing banks to have more free cash to drive economic growth, which should help boost liquidity by $142 billion. Furthermore, better loan facilities were made to help increase share buybacks. The People's Bank of China is allowing companies to take out loans through commercial banks at only 2.25% to boost share buybacks. Overall, the government has promised over $112 billion for the schemes to help pump up the markets. Check out this video here if you would like to find out more about what caused the significant Chinese stock market rally in 2024. Major bullish and bearish factors. Michael Burry's portfolio for Scion Asset Management has little more than 45% of its declared holdings in large-cap Chinese companies. A reason for his bullish view comes from the trailing 12-month PE ratio for the companies, which is significantly lower than the S&P 500 PE ratio, which is currently 29. Furthermore, large-cap U.S. tech companies such as Nvidia have now hit 65, and Apple is at 35. He's clearly not seeing as much value in large-cap Western companies compared to their Chinese counterparts. Despite the recent rise, China's major stocks such as Alibaba, Baidu, and JD still look relatively cheap compared to their earnings. One could argue they have moved from being very cheap to just being cheap. The three companies look likely to maintain double-digit growth rates as they continue to show strong fundamentals. For example, Alibaba has a substantial cash position that accounts for nearly 50% of its market cap, contributing to a low enterprise value-to-cash flow ratio. As U.S. equities reach what some investors consider overvalued levels, many are looking to allocate capital to other markets. China's stock market has become a focal point for international investors. The valuation gap between U.S. and Chinese equities is considerable, leading to an anticipated rebalancing of global capital flows toward Chinese markets. The positive sentiment is reinforced by funds such as Michael Burry's Scion Asset Management. However, similar rebounds have been seen in the past, but this one comes with its own unique risks and opportunities, which you must weigh up. You must do your own research before buying any stock, especially if it's a company in a different country or industry you're unfamiliar with. Stock investing has historically been less popular in China compared to other major economies. This sudden influx of new trading activity suggests a potential cultural shift in how Chinese households allocate their wealth. However, the surge in enthusiasm has raised questions about whether it's driven by strong fundamentals or short-term speculative excitement. The Chinese government's heavy-handed approach to managing its economy and stock market has historically created unpredictable swings on company valuations. Crackdowns on tech giants like Alibaba, which lost over 80% of its value following government-imposed antitrust fines, are a reminder of how swiftly Chinese policies can impact major businesses. However, Xi Jinping wants to change this narrative by providing central banks with cheap funding to give companies a better chance to increase returns for shareholders. Chinese firms hit all-time high free cash flow levels last year by hitting 18 trillion yuan, or $2.53 trillion, according to Goldman Sachs. Higher shareholder returns would cycle back to the state owners, which account for 48% of Chinese equity market value. The benefits for Xi Jinping and the Chinese government are clearly significant enough for them to invest so much money into stimulating the stock market. Check out these fascinating financial stories here. Thanks, guys.